give it to you, generally very straightforward paper, who basically prices CDSs. And it starts with a very simple assertion. Suppose that suppose, first of all, that I live in a world with no interest rates. All interest rates are zero. This is a pretty good description of today's world. That the underlying name has a probability of default, PD, which is say 10% per year.
What is that? PD, what is PD?
Probability of default. That the said name has a recovery rate of say 40%. And suppose that this is flat in time, that's 10% per year, every year from now to infinity. Okay? Then, what we have is the following. Okay. Suppose I want to sell you a 1-year protection on this name. What would be the right amount of spread to ask for? Now let's make another simplifying assumption. It's 3. Defaults can occur only at the end of the year. Okay. So as to avoid this thing, what's going to happen if someone defaults between 2 premium payments? Okay, defaults can occur at the end of the year. How would I go about finding the correct valuation, the correct spread for the CDS? Very, very simple statistics. Okay? I have a 2-state world. In 1 year from now, either this name is alive or he's dead. Okay? So in 1 year from now, I have 10%. PD equals 10% dead, and I have 1 minus PD equals 90% alive. Okay? If he's dead, what is going to be my net? If he's dead, okay, what is going to be my my cash flow? Suppose he's dead. What's going to be my total return from this investment? Yes?
Recovery rate.
I am a protection seller, so I have to pay 100 and receive the recovery rate. So it's going to be 1 minus the recovery rate. What is going to be my return if he's alive? 1 premium. Yeah, the premium. So it's going to be my X. So it's this very, very simple formula here. And you see where I'm driving at. It's a very, very simple formula. Okay, that says X times 1 minus PD equals 1 minus R times PD. So X equals 1 minus R times PD over 1 minus PD. correct? In this case, it is 10%, 10% times 60% over 90%, which is about, I think, 6.6%. Now you see where I'm driving at, okay? And this just came out of the discussion we had earlier. Do you notice something strange here? Is x bounded? Is there an upper limit on x? Could x ever be above 100%? Why? What's the limit as PD goes to 1? It's infinity. As PD goes to 1, the limit for x is infinity.
R is always larger than the PD.
No, R is between 0 and 1. R is a recovery rate. R is a conditional number. Given that
Default as R.
given that default came, what's the recovery? So R is a property, say, usually of legal stuff. So between 0 and 1. PD is also between 0 and 1. But X, in this case, is between 0 and infinity. And this is actually what's happening in the marketplace. Names that have very, very big probabilities of default in the short term, they command CDS premiums which are well in excess of 100%. I cannot open Bloomberg. Can you guys open Bloomberg? You can look at the CDS spreads of the CDS spreads for Hellenic Republic around June of 2015. And the CDS spreads were of the order of 30,000 basis points. 30,000 basis points is 300%. Okay? And why is it so big? It's this factor here. It's the fact that if default becomes imminent, then this huge spread has a very, very large probability that you'll never get it. Because default will come and you'll only get peanuts, you'll get some accruals. If you don't, suppose now that you happen to be a protection buyer in this thing, okay? And the catastrophe that you try to protect against does not happen, you're screwed. You're screwed. Because you pay an enormous amount of money that nobody expected you to pay, but you'll be paying it, and you'll be paying it for a year, for 2 years, for 3 years. So essentially, trying to buy credit insurance when things are really, really bad is a very, very unsound risk management decision. And to make it even worse, what was quoted originally in the marketplace were just this hugely inflated spreads. Okay? And you couldn't even deduce those PDs from the hugely inflated spreads because, given this, if you have this, you still cannot deduce the PD because you need R. And R generally is not quoted in the market. So there was an enormous uncertainty, not only what this spread really meant, but given that you had a deal at a certain spread and the spread moved, exactly how much was the mark-to-market of this? Because in order to find the mark-to-market, you needed the recovery. So at some point, there was an enormous uncertainty, the whole CDS market was collapsing, and they said, we're going to change this. Okay? We are going to change the way CDS spreads are quoted, and we say CDS spreads are quoted at 500 basis points per year. This is it. Of course, there are names that are far less risky or more risky than 500 basis points per year. The rest would be quoted as an upfront payment. So, in this way, you removed the possibility of having an enormous credit spread to be paid by someone who made the poor judgment of buying protection at the wrong time. Because if you have an upfront payment, then the most you may need to pay upfront is 100. Because this is it. And you say, I pay 100 upfront. Again, it's this whole interplay between PD, R, and accruals that... By the way, is this the first time you hear about CDSs and CDS pricings?
Yeah, definitely.
You didn't do it with the derivative price?
No.
Okay. So yeah, CDS is... Essentially, CDS is like saying the following. It's like saying the following. Of any kind of, going short, any kind of short position has an infinite downside. We all know that. Technically, in every model, the price of a stock can go to infinity, cannot go below zero. So if you go short, technically, you can have an infinite downside. That's why people don't like short. Doing this is roughly equivalent to going short a bond, which the price of which has gone to very little, 5, not based on a notional amount, but based on a market value. It's not I'm going short 100 million worth of notional amount of the bond. It's saying going short 100 million worth of market value for the bond. As the price goes to zero and you try to enter at the wrong time, technically when the price is zero, you go short for an infinite notional amount. Because you go short something, the price of which is zero, for a euro amount of 100 million or a million. So you go short infinite notional amount. If you get it wrong, you got an infinite downside. It's exactly the same thing as here. You try to enter this deal when PD goes to 1, this X is 0. I mean, this X is infinite. If PD is assumed to go to 1 and then a miracle happens and this guy doesn't default, you're screwed. That's very bad risk management. Okay, that was about CDS. Now CDS is the easy stuff because securitization is the hard stuff. We talked about securitization. We'll talk about in a little more depth when we talk about credit VaR. Exactly the same mechanism that you use for credit VaR, you use it to price securitizations. Oh, by the way, one thing we discussed before is we're going to have, say, an informal session, a couple of hours, 3 hours maybe, whereby you can ask questions, we can look spreadsheet modeling, talk about the exam, like no schedule, just question and answer. So it's going to be open, whoever wants to come. Okay, now going at the portfolio level, significant differences between credit and market risk. Well, there is one big significant difference. Okay? I have a stock. The stock, it's worth 10 cents, 10 euros. It may double in value, it may go to half in value. It's got a very large spread of prices around its current price. So the return of a stock portfolio can have a pretty wide range of outcomes. If I have a bond, which I buy at par, generally, this bond will trade around par, generally. There are exceptions, of course, but generally it cannot go much above par, okay, and cannot go much below par unless there is a risk of a credit event. If there is a credit event, it will go maybe down to 0. So it's much more lopsided. Okay? You see, a market portfolio, this is a realistic distribution of the return of a market portfolio. This is a realistic distribution of the return of a credit portfolio. It has pretty much a hard maximum. It is generally very near its initial value. But then you got a long tail of improbable large losses. So this is probably the biggest difference. Now, going into more detail, actually everything we talk about will derive from that. For the fact that a credit portfolio has an event built in. What? A credit event. Now, asset dynamics, market, simple models, lots of repricings, lots of time series analysis, well understood, easy to backtest. Credit, much smaller values of defaults. Well, of course, you've got many defaults in history, but there are asset classes, for example, sovereigns, where you don't have that many defaults in history. You don't have that many sovereigns. You've got 160 sovereigns. Now, how many defaults can you get? Maybe you get one default every decade, things like that. So, a lot more sparse asset dynamics, much easier, much harder to model, to backtest, and of course we talked about defaults. Think about concurrent defaults. Then becomes even more sparse. As a result of that, what do we have? Correlations. Correlations are much harder to grasp. You go into the market universe, you have correlation of returns. You've got the rho xy. You've got the covariance and correlation of a normal distribution. This. What we described as this, rho xy. The rho. Okay. You go to credit, you got correlations of events. Correlations of events. Much more sparse, much harder to grasp. Okay. Also, something that creates even more problems. Generally, value at risk is subadditive in market portfolios. That means I got a portfolio that has one stock, which is worth 100, and it's got, say, a VAR of 20%. If I have a portfolio which has 10 stocks, which are worth 10 each, to make up a total value of 100, then the value at risk is generally smaller than 1%. And you remember when we said in the market, when we said that the value at risk was had this form. What's happening with markers? It had this form here. Okay, sigma 1 squared plus sigma 2 squared plus 2 rho sigma 1 sigma 2. You remember that?
Yep.
And we said, why are we saying this? We are saying this because we are making a linear extrapolation. Everything there had to do with the Taylor expansion of the risk factors. Okay? You go to the credit world. The credit world is based on events. This is par excellence the most non-linear structure you can have. It's an event. It's discontinuous. 0 or 1. So, check this very simple example. We have two bonds, uncorrelated. Each of them has a 75 basis point, 0.75% probability of default per year. 1 year VAR, and suppose that, for example, if this bond defaults, the loss I have is the entire notional. If it doesn't default, the return I have is 0. Very simple. I have one bond, okay? what is my 99% VAR of this one bond portfolio of 100,000? Exactly, it's 0. Because the event does not occur to 99% confidence level. Suppose I have 2 bonds of 50K each, making up $100,000 of each portfolio. What are my statistics? Now, remember I have 2 bonds, each of them has a 1% probability, 0.75% probability of default, but and their defaults are independent. How many defaults can I have at the end of the period? 1, 0, 1, or 2. 0 defaults, 1 default, 2 defaults. Okay? What is the probability that I have 0 defaults? Let's have a probability tree. This is bond 1, 99.25 no default, 0.75 default. This is bond 2, it's 99.25 no default, 0.75 default. 99.25 no default, 0.75 default. And this is, how many defaults are in this node of the tree? 0. How many defaults are in this? This doesn't default, this defaults 1. How many defaults are here?
1.
This defaults, this doesn't default 1. And how many defaults are here? 2. Okay, so what is the chance of having 2 defaults? It's 0.75% squared. Okay? What is the chance of having 1 default? It is 0.75 times 2 times 99.25% times 0.75%. And what's the chance of having 0 defaults? It's 99.25% squared. Question, is this number bigger than 1 or smaller than 1? Just by reading it.
Big.
It's bigger than 1. This is close to 2 times 0.75%. This is close to 1.5%. So, I increased my diversification, but my value at risk at 99% confidence level increased. This is a very blatant property of credit portfolios. It can also be a property of highly nonlinear market portfolios that have features that resemble events.
Like call options, something with call options, or
Something with call options, it does have something that resemble events. Something with binary options also has something that resembles events. Something with CDSs, again it resembles events. That's why there are, by the way, value at risk is subadditive. I'm sorry, value at risk is not subadditive. Expected shortfall is subadditive. So, what is the expected value of the loss beyond a certain confidence level? This improves with diversification. But the event nature, what happens at the confidence level does not necessarily improve with diversification. We saw that here. Okay, now let's go into the mechanics of pricing debt. Okay. Now we all know the Black-Scholes formula. Okay, or we've heard of it, or we know what it's about. And you say, what is Black-Scholes formula about? It's got to do with pricing options. Actually, the first time the Black-Scholes formula was utilized the first paper came out by Merton, and it was called On the Price of Corporate Debt. Black-Scholes formula was originally used to price debt. Now, what is the connection between debt and the world of options? If you think about it, okay, debt is essentially a put option, okay, on the value of the firm's assets, will strike the value of the firm's debt that the debt holders have written and the firm holders have bought. Okay? The price for this option is the credit premium. Let's repeat that. It doesn't come very intuitive. Okay? Suppose I have a firm that has assets that are worth, say, S. Let's see, can we get more? Can we get more of this? Hey, can I show you? Just